This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
I think required minimum distributions get a bad rap. Yes, they're required, and yes, there's a minimum that will need to come out of your IRA accounts, and yes, you'll need to pay taxes on the amount that comes out. However, would you believe that there's a lot more nuance to your required minimum distribution beyond those things? It really is. My goal for today is to give you a number of other ways of looking at your required minimum distributions beyond, I got to take money out of my IRA account and pay taxes on it. So for today's Wise Investor Show, I'm going to be discussing required minimum distributions, how they're calculated, what's involved with distributing them out of your IRA accounts, and different things you can do with them and ways to look at them that could add a bit more value to your life. So after giving required minimum distributions a lot of thought, it is my pleasure to bring to you today's show topic, which is going to focus on required minimum distributions, how it is you've come to be subject to them, ways you can go about fulfilling your end of the distribution requirement, and how you can potentially use them to your advantage. Welcome to the Saturday, April 4th edition of the Wise Investor Show. It's my pleasure to be here with you today, and welcome on board. I'm Greg Smith, certified financial planner and partner with the Wise Investor Group of Raymond James in my 27th year now with the team, and of course enjoying every minute of it. We have an amazing group of specialists here at the team, all of us doing what we do best and enjoy doing the most, working in concert with one another for our clients to help every single individual and family we work with accomplish their own uniquely different sets of goals and objectives. We do so with a strong emphasis on financial planning, something tangible, something visual that we update regularly so you always know where you stand relative to what you want. It's a great way to help you sleep better at night, especially when things get bumpy in the markets, as they tend to do from time to time, as you may have noticed. So if we can help you or someone you care about, please let us know by reaching out to me at gregory.s.smith@raymondjames.com or by calling us at the front desk at 571-430-7200. That's 571-430-7200. And then the last thing that I'll say is that the ideas and observations I'll be mentioning on today's show are just simply my ideas, and I recommend that you speak with your tax preparer, your attorney, or your financial advisor before implementing anything I happen to talk about today. And with that, let's get to it. Let's talk about ways to think about your required minimum distributions beyond merely just being forced to distribute out money from your IRA and thus paying taxes on those distributions. All right, so what are required minimum distributions and how does one arrive at being subject to them? Well, I'm glad you asked. Required minimum distributions, or RMDs as they're often referred to in our industry, is where you either have inherited an IRA, you're going to be subject to required distributions upon inheriting an IRA, or you have your own IRA and you've reached the age of 73 and beyond and have an IRA in your name. IRAs, tax-deferred accounts in general, were never intended to be used as permanent tax shelters. They were set up to serve as a tax benefit to taxpayers while they were contributing to them. As contributions, when you made contributions during your working years, it lowered your income and thus you reduced your taxes while you contributed. And then also between the ages of 59 and a half and your required minimum distribution age, currently 73, well then you could take out as much or as little money as you wanted, so long as you paid the ordinary income taxes on the amount that you withdrew. Between ages 59 and a half and actually 72, there's no longer that 10% penalty for taking money out of your IRA, and there are no required minimum distributions between those ages, between 59 and a half and 72. It's not now until the year in which you turn 73, at which point you have to begin taking out funds whether or not you wanted to. The amount that you have to take out is referred to as your required minimum distribution, the RMD. Now, you can take out more than the required minimum, just not less than the required minimum distribution. You get subject to the required minimum distribution because ultimately Uncle Sam wants to get paid. And Uncle Sam gets paid because, generally speaking, every dollar that comes out of your IRA account is taxable to you as ordinary income. And by your distributing out funds from your IRA, you're also going to be owing income taxes on the amount that gets distributed out of your IRA account. And you're going to want to make sure that you do, in fact, satisfy your required minimum distribution, because there's this nasty 25% penalty, or what they call excise tax, on what should have come out but didn't if you fail to distribute out your required minimum amount. Now, you might be able to reduce that percentage, that penalty, to 10% if you missed it, but if you act promptly to correct it. The best thing to do, of course, is to be aware of what your required minimum distribution is and to make sure that it comes out before the end of the year. You'll see it on your statements, you'll see it when you log in and view your accounts, and you ought to know what it is if you're in good contact with your advisor. You can also be subject to required minimum distributions even if you're not yet age 73. You can be subject to required minimum distributions if you happen to have inherited an IRA. Inherited IRAs, whether you inherited them prior to the year 2020 or after the year 2020, have required minimum distributions associated with them. RMDs weren't really being enforced for the first several years on IRAs that were inherited after 2020, but they are now. So if you have an inherited traditional IRA, then you too are subject to required minimum distributions no matter your age. I get asked a lot about how required minimum distributions are determined. How do they calculate your required minimum distribution? Well, your required minimum distribution is predicated on three important components. Number one, what your IRA account balance was worth at the end of the previous year. That's number one. Number two, the corresponding factor or divisor or number that goes in the denominator that corresponds to your age. There's an IRS table that is uniform for everybody unless you happen to have a spouse that is more than 10 years younger than you. If you're married to someone who is more than 10 years younger than you and your spouse is the primary beneficiary of your IRA, then you have a slightly more favorable distribution table. But for everyone else, there's a standard IRS table that we all refer to called the Uniform Lifetime Table that pretty much dictates the pace at which you have to take out your required minimum distributions. You divide your year-end account balance from last year's December 31st balance, and you divide it by your corresponding factor, that number that you find from the Uniform Lifetime Table. And then the third item, the quotient, or the answer to that math problem, is your required minimum distribution amount that needs to come out of your IRA account this year. I'll give you an example. Someone who's turning 73 this year happens to have a factor of 26.5. Let's also say that this 73-year-old also has $1 million in their IRA account as of the end of last year. That was their December 31st of last year's ending account balance. You take your $1 million account balance at the end of last year divided by your age 73 factor of 26.5, and that equals $37,736, or essentially 3.77% of your IRA that needs to come out the first year that you're subject to required minimum distributions, 3.77% the first year. Now, you don't need to take it out by your birthday. You don't need to take it out before April 15th. Those are fictitious numbers. Just so long as it comes out in the calendar year in which you turn 73, then you'll be just fine. If you're 73 this year, you have a factor of 26.5, that's the number going in the denominator, while your year-end account balance from December 31st last year goes in the numerator. The next year, your factor changes from 26.5 to 25.5, which means that you go from distributing out 3.77% the first year, up to 3.9%, a slight increase. You'll notice that over time, the percentage of your IRA account that you'll need to distribute out grows over time. The third year of being subject to required minimum distributions, your factor goes to 24.6, roughly 4.1% of your IRA account needs to come out. So even though the percentage that you'll have to take out over time does grow, it never reaches 100%. You never have to fully distribute out your own IRA account, even when you're 105 years of age. 4.6 is your factor, where you're distributing out about 22% of your IRA account. That's at 105. It's a bunch, but it's not 100%. At no point do you ever have to distribute out all of your IRA money from your own IRA account. The rules are quite different if you're subject to required minimum distributions as a result of having inherited an IRA account. If you inherited an IRA prior to 2020, then you are still able to make use of that stretch IRA concept and take out distributions for years and years to come. You've already probably gotten into the rhythm of it, and you know to take out your required minimum distribution every year based on the IRS's single life expectancy chart. So easy enough, requires not too much thought other than taking it out from your IRA account, whatever your brokerage house tells you that you need to take out. Simple, right? Right. Well, for those of you that have inherited IRAs in the year 2020 or later, then you have a completely different set of rules to contend with. And not only is there a required minimum distribution involved, so too is the requirement to really consider your income and your income trajectory, or consult with your financial advisor on how much to take out from your inherited IRA going forward. The reason for needing to give distributions from an inherited IRA more thought is that you have a deadline. You have 10 years to distribute it all out. That's it. No stretch IRA concept anymore for IRAs that you inherit in the year 2020 or beyond. If you have an inherited IRA, especially an IRA of size and heft, well then you're going to want to plan out whether you want to take out just the required minimum distribution, or if you would rather work towards spreading out the distributions fairly evenly over the 10 years, essentially 10 tax years that you have to work with. This is where speaking with your tax preparer and or your financial planner really comes in. You'll want to map it out and see what distribution schedule works best and saves you the most in taxation along the way. What you typically don't want to do is take out the bare minimum every year and then be potentially left with this enormous spike of income in the 10th year that you'll have to pay all these ordinary income taxes on. And if it is an IRA of substantial value that could put you conceivably in the highest tax bracket were it all to come out in a single year, then you most definitely will want to think about spreading out the distributions over the time that you have to pay at the lowest tax brackets possible along the way, rather than planning to defer it only to pay at the highest brackets in the last year, the 10th year. It could make an enormous difference to you and your family by the end of the plan to give it some additional thought and planning as to how you'll take out your required minimum distributions over the 10 years that you have to work with. I've seen it make hundreds and hundreds of thousands to millions of dollars worth of difference to adopt the right distribution strategy for a given set of circumstances. So, okay, once you're subject to required minimum distributions, how do you go about holding up your end of the bargain and taking out the amount you're supposed to take out? Well, you actually have quite a number of choices as to how you can take out your required distribution, and you're never really ever locked into any approach from one year to the next. So that means you can change your mind on your distribution approach from year to year based on what's most helpful to you and your family, depending on what else you might have going on cash flow-wise in your life. So when I come back from this short, tiny little break, I'm going to share with you some of the choices that you have when it comes to how to distribute out your required minimum distribution. You're listening to Greg Smith, Certified Financial Planner with the Wise Investor Group of Raymond James, and I'll be right back with ideas coming your way. Stay with me.
Midterm election years are almost always the most volatile, and so far 2026 is proving no exception. Will you let the inevitable churn in your political leanings disrupt your plan and portfolio? Tune in every week as we discuss the latest financial trends and what investors need to know. To avoid the endless barrage of distractions and become a better informed, wise investor, listen to us at The Wise Investor Show at raymondjames.com/The Wise Investor Group. Or just find us on your favorite podcast app. Raymond James & Associates Incorporated, member New York Stock Exchange, SIPC.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James & Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James & Associates, Inc., member New York Stock Exchange, SIPC.
Thank you, and welcome back to the Wise Investors Show. I'm Greg Smith, your most grateful host for today, and I'm so glad to have you here with me. I'm talking about ways to consider how you go about distributing out your required minimum distribution so as to add extra value to your life, financial and otherwise. Here are my 6 ideas in no particular order, and please do, by all means, discuss these with your financial planner and tax preparer before implementing, as you might be a candidate for making use of maybe 2 or more of these ideas in a given year. Well, let's get started. Idea number 1. If you are retired, or if you could use the money, you can divide your required minimum distribution by 12 in early January, once you know what your required distribution is, and then simply take out 12 equal distributions monthly to be deposited to your local checking account after federal and state income taxes are withheld. And that way, you get to enjoy the extra spending cash coming in monthly for your use and enjoyment, and know that by the end of the year, your required minimum distribution will have been satisfied. Easy enough. Number 2, if you do not need the money from your IRA account, then you can simply transfer over the after-tax component of your required distribution over to your individual account or your joint account and put it to work there. No reason to let your required minimum distribution languish in your checking account earning nothing. Move it over to your investment account. Put it to work. Let it grow and compound for the future. Only it would be growing and compounding in an after-tax environment. For some individuals and families I meet with, they like the idea of bolstering their accounts just in case the need for care arises in the future. By taking your required minimum distribution, by putting it to work in an after-tax account for later, it can feel really good to still be continuing to save and invest against potential future risks and costs. Number 3, if you don't need the money from your required minimum distribution and are charitably inclined, then a great approach for you is to make use of the QCD, the Qualified Charitable Distribution. If you belong to a place of worship that you pay dues to regularly, this could be a great idea for you. By sending a qualified charitable distribution check to your favorite charity or charities, the amount that you send from your IRA to charity up to a maximum this year of up to $111,000 counts towards satisfying that component of your required minimum distribution But what you send to charity via the QCD does not count as income taxable income. So if you're charitable and subject to required minimum distributions, the QCD is the first place I'd go for where to get your charitable dollars from. Makes the most sense. Number 4, it doesn't happen often, but it does happen from time to time. When someone retires, they might have a hard time shifting from the mode of saving to the mode of spending. It can be a difficult transition for some people. But when there is a required minimum distribution involved, it can make that transition from saving to spending a little bit easier because the money's got to come out anyway. Required minimum distributions provide that extra cover of encouragement to distribute money out of an account that's likely been invested in growing tax-deferred for quite some time. Required minimum distributions can also come in handy if you're starting to run short on liquidity. If you're subject to required minimum distributions and could use some extra liquidity, then take it out. It's got to come out anyway. So if you otherwise were able to pay your bills from Social Security and pension benefits and any other income you might have had, but you had a big major expense coming up, well then being subject to required minimum distributions may not be such a bad thing, since you could use the money and it was going to have to come out anyway at some point during the year. I've had clients that have had to repair their roof or buy a new car. They've made good use of their required minimum distribution to help offset the cost simply because it was going to have to come out regardless. You might as well take it out when you need it. Number 5. But what if you don't need the liquidity and you don't need the money out of your IRA account to live off of? Well, no one says you have to distribute out cash. You can always distribute out securities from your IRA account to your individual or joint or trust investment account. That's another option that you have when you're subject to required minimum distributions. The value of the security or securities that come out of your IRA account that get moved over to your after-tax investment account will satisfy that amount of your required minimum distribution. And then you can continue to let it grow and compound over time over in your after-tax investment account. Oh, and by the way, once it gets moved out of your IRA and into your after-tax account, it gets a step up in basis to whatever it was worth on the day that you moved it out of your IRA. And from there, if it appreciates and you sell it, well, then you'll pay capital gains taxes on it. And if it loses value from the day that you moved it out of your IRA and you wanted to sell it, you could harvest a capital loss and thus get potentially some tax benefits once you sell it. So this approach tends to work best if you're accustomed to paying quarterly estimated tax payments, since you really wouldn't be doing any withholding using this approach of distributing out securities themselves from your IRA account. Number 6, still going. This idea that is one that I've mentioned to folks who find that paying their quarterly estimated tax payments are a real chore. If you lack liquidity, or if you find that you have to recognize gains in your taxable account in order to pay your quarterly estimated tax payments, something that you can do is work with your tax preparer and custodian of your IRA account to withhold a percentage that is large enough to cover your quarterly estimated tax payments and keep you in the safe harbor. See, when you send in your quarterly tax payments, they're due by certain dates: April 15th, June 15th, September 15th, January 15th. However, depending on your cash flow, as well as your memory and organizational skills, many people find it easier to send in an outsized IRA payment to the IRS, as well as their state treasury department, via the required minimum distribution if your RMD is large enough. There may be a side benefit to using this method of doing the extra withholding to obviate the need for paying quarterly estimated tax payments. So whereas your quarterly estimated tax payments are due by certain deadlines, the tax withholding that takes place from your IRA distributions, they aren't really time-stamped. It doesn't matter if the distribution takes place in January or December. The money withheld for taxes from your IRA account are treated as though they were paid throughout the year, regardless of when the distribution and thus the withholding actually took place. So rather than parting with your after-tax liquidity throughout the year, you can have use of your IRA account and the income that you get on it all year until December, and then withhold enough from your IRA and federal and state income taxes to land you in the safe harbor. Of course, you'll need to work with your tax preparer and financial advisor to determine what percentage of your required minimum distribution should be withheld. And if you do it right, you won't need to be paying quarterly estimated tax payments if you don't want to. So even though you might have to give up an outsized percentage of your IRA distribution, you will have had use of your liquidity and your cash throughout the year, and you didn't have to worry about sending in quarterly estimated checks by the deadlines, and you didn't have to recognize gains in your taxable portfolio to be able to make those quarterly payments. So it's really certainly worth a discussion with your tax preparer and your financial advisor to determine if this required minimum distribution strategy is a technique that you might want to make use of. So with those 6 different strategies for taking money out of your IRA via the required minimum distribution, I hope that you can get a better feel for some of the choices that you have. There is no one-size-fits-all model, and one approach or set of approaches may work better in some years, and other approaches may work better in other years. So to wrap up, some of the ideas that we covered today include, number 1, dividing up your required minimum distribution into 12 equal monthly installments for improved monthly cash flow. Number 2, distributing out and then saving and investing your required minimum distribution over into your investment account for continued growth and compounding. That's if you don't really need the money. Number 3, sending some of your required minimum distribution to charity using the QCD, the Qualified Charitable Distribution, to save you money in taxes and keep your income as low as possible. Number 4, regarding your required minimum distribution is permission, if not encouragement, to spend a little, whereas you might otherwise have been disinclined to. Number 5, moving out securities themselves from your IRA account to satisfy your required minimum distribution without having to sell anything. To lastly, number 6, with the help of your tax preparer and financial advisor, determining what percentage of tax withholding, and it could possibly be a very large hunk of your distribution, that removes and obviates the need for your paying quarterly estimated tax payments. So you certainly have a number of options and approaches at your disposal when it comes to taking out your required minimum distributions. You get to choose the approach that is right for you and your family, and it could very well be that you're employing one or more of these approaches in a given year might work best for you. And if you happen to have any questions about anything that I covered today, I'll be glad to chat about it with you in depth anytime. Feel free to reach out to me at gregory.s.smith@raymondjames.com or give me a call anytime at 571-430-7200, and I'll be glad to continue the conversation. My partner and portfolio manager, Simon Hamilton, will be hosting next week's April 11th podcast. And until then, this is Greg Smith, Senior Financial Planner with the Wise Investor Group. Thanks so much for your time, and I wish you wise investing.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.